In this video, we continue our discussion on Chapter 8, where in our last video we gave an initial view of total revenue as well as defined profits for a firm. In today's video, we seek to examine how a firm maximizes profits by setting up some preliminaries to then go over marginal cost, marginal revenue, and the profit maximization process for an example firm operating in a particular market structure. Beginning with our preliminaries, we so far know that firms will produce goods and services, and when they produce those goods and services, money will flow out of the firm in the form of costs, and with those goods and services that they produce, they can sell them at a particular price point and have money flow into the firm in the form of revenue, where the difference between revenue and costs will be profits for the firm, where we know that profits are the overall want for the firm. So with this information, we now seek to address how the firm makes its decisions. And to do so, let us motivate this discussion through an example firm in a particular market structure, where recall that we also need market structure in order to see how the firm prices their goods and services, and as a result, in order to determine their revenue structure. To elaborate a bit more on market structure though first, recall that in our last video we defined it as the number and relative sizes of firms in an industry, where some examples of market structures include perfect competition, monopolistic competition, oligopolies, duopolies, and monopolies, where in terms of characteristics, starting with perfect competition, we see that there's many buyers and sellers, where each of these agents have no market power, that is the ability to influence the price on a good or service. And as we move down from our table, we see that the number of firms in these market structures begins declining, while market power begins increasing. So what we seek to do is in our following chapters, when we move to partial equilibrium analysis, is examine how price and quantity are determined in a particular market structure and compare them to see which could be a more favorable outcome, where we will use perfect competition as our base case, and in terms of our example firm in this chapter, we will also be working with perfect competition. So to define a perfectly competitive market space, this is going to be a market in which there's many buyers and sellers, where each of these agents has no market power, or once again, this is the ability to influence the price on a good or service. And in terms of characteristics for our space, there's going to be many firms operating in this type of market, where each firm will sell an identical product, and there's low barriers to entry for this firm to enter or exit the space. That is, there's little to no costs in order to begin operation or to cease operation. And in terms of the output that's being produced by an individual firm, it's going to be small relative to the amount of total output that's being produced in that market. And as mentioned, no firm has market power such that each firm will be a price taker. That is, they take price as a given, as it will be determined within the market itself. So then with this information, the process that a competitive firm will use in order to maximize profits is that they will produce goods and services using their factors of production, where when they produce those goods and services, they will incur costs from their input resources, and when they sell the goods and services that they produced, revenue is generated from the sale, where the difference between revenue and costs is going to be profits, where so far this is nothing new. And when the firm decides to produce an additional unit of a good or service, they will compare additional revenue to additional cost to see what their incentives are. That is, they will compare additional money flowing in versus additional money flowing out. Therefore, the items of interest to us in terms of profit maximization will be marginal revenue as well as marginal cost. So let us proceed with our example then. Let us suppose that we have a competitive farm that grows crops with a fixed amount of capital and a variable amount of labor. So we know that we're going to be looking at a short-run production process, which we're given graphically and through a table representation below, where crops is going to be on the vertical axis, quantity of labor is on the horizontal axis, where we see that as more labor is being used, more crops can be produced, but it's going to be at a declining rate due to diminishing returns on labor. And we can verify that more inputs leads to more outputs in our table representation. And if we were to work through the calculation of the marginal physical product, we could also see that it's positive but declining. So then with our production process in order, now we need to determine the firm's cost structure and its rate of change, that is marginal cost, as well as the revenue structure and its rate of change in the form of marginal revenue. So, beginning with costs, let us suppose that the firm is paying fixed capital payments of $100 and that each farmer, which will be our labor, is paid a wage rate of $20. So in terms of our graphical representation of total cost, we have that on the left, and we also have a table representation on the right. In terms of our graphical representation, cost is going to be on the vertical axis, quantity of crops is going to be on the horizontal. We know that since fixed costs are non-zero, that means when production is 0, that means total cost will be non-zero, as we see with point A. And since we have a variable amount of labor, we see that total cost is increasing as more crops is being produced, as expected. And in terms of keeping track of this of our table representation, we see that fixed costs are 100, regardless of the amount of crops that are being produced. And that in terms of variable costs, we see that when 0 amounts of labor is being used, there are 0 variable costs. And as each farmer is being added, they have to be paid a wage rate of $20. So going from 0 farmers to 5 farmers, this goes up to $100. And then summing fixed and variable costs, we can get total cost at each point, giving us the corresponding cost structure for the amount of crops that's being produced. Now, in terms of the rate of change, we know that this is going to be marginal cost, where this is going to be the slope of the cost function, and that is going to be the change in total cost divided by the change in production. And we know that marginal cost is upward sloping due to diminishing returns on labor, as we see with our marginal cost graph on the right, where cost is on the vertical axis and crops is on the horizontal axis, and we see from points B to C, C to D, D to E, and E to F that marginal cost is increasing. And another way we restated that is that our change in total cost is going to be positive, and our change in production is also going to be positive, and that our change in total cost will outweigh the change in production, which gives us that interpretation of an upward sloping marginal cost curve. If we were to work through 2 points to get a better illustration of this, let us look at our table representation. In terms of marginal cost going from point A to point B, in terms of our numerator of total cost is going from $100 to $120, so the difference between the two will give us a value of 20. In terms of our denominator, the change in production, this is going from 0 to 10, so this is going to be 10 minus 0, giving us a value of 10. And numerator divided by our denominator will give us a value of 2, which generates point B on our marginal cost graph. If we were to do the same for point B to C, we see that in terms of the change in total cost, this is going from 120 to 140. So our numerator is going to be 140 minus 120, giving us a value of 20. And in terms of the change in production, this is going from 10 to 18. So our denominator is going to be 18 minus 10. Our numerator divided by our denominator gives us a value of 2.5 that we see on our marginal cost graph. If we were to repeat this, we would get those numerical values of 5, 10, and 20 at the corresponding output levels of 22, 24, and 25, which gives us that upward sloping curve as expected. Now, moving on to our revenue structure. Since the farm is in a competitive market, it takes the price as given. So, suppose that the price point of crops in the market is priced at $10. We know that revenue is going to be price times quantity, so this is going to be 10 times the quantity of crops being sold by this farm. And since price is going to act as our slope, and it's constant, this is going to give us a positive and linear relationship between crops and revenue, as we see in our graphical representation of total revenue on the left, where revenue is on the vertical axis and crops is on the horizontal axis, where we see that as crops is increasing, so is revenue, and we see that it's at a constant rate as we go from points A all the way to F. And if we were to keep track of this in terms of our table representation, where we have crops sold and the corresponding price point of 10, we see that the price point of 10 stays the same regardless of the amount of output that's being sold. And in terms of price times quantity, 0 times 10 gives us 0 revenue, 10 times 10 gives us $100 in terms of revenue, and so on and so forth, where at point F we would have 25 times 10 giving us a value of $250 in terms of total revenue. Now we're interested in keeping track of the rate of change of total revenue. That is marginal revenue, and it's going to be the slope of the revenue function, where since total revenue is positive and linear, that is, it has a constant rate of change. In terms of marginal revenue, where marginal revenue is going to have revenue on the vertical axis and quantity of crops on the horizontal axis, we'll have a positive constant marginal revenue structure. To see why that is, turning to our numerical calculation, it's going to be the change in total revenue divided by the change in output sold. So calculating 2 points, going from point A to point B in terms of our revenue structure, the change in revenue is going from $0 to $100. So 100 minus 0 for our numerator, giving us 100, divided by going from 0 to 10 in terms of our change in output sold. So 10 minus 0, which is 10. 100 divided by 10 gives us a value of 10, generating point B on our marginal revenue graph. And in terms of going from point B to C on our revenue graph, we see that the change in total revenue is going from $100 to $180. So 180 minus 100 gives us a value of 80. Then 18 minus 10, since we're going from 10 to 18, gives us a value of 8. 80 divided by 8 also gives us a value of 10, as we see with point C. And if we were to repeat this, going from C to D, D to E, and E to F, we would also see that we'd have $10 regardless of the amount of output that's being produced. Now putting it all together in terms of our production process as well as marginal cost and marginal revenue for this farm, we can determine the production decision that maximizes profits. Turning to our production function, if this farm is considering using 0 amounts of labor, such as at point A, we note that this means that 0 crops will be produced, and marginal revenue and marginal cost will be a non-factor in terms of this analysis. So then this farm decides to go from point A to point B, so they're using 1 unit of labor in order to produce 10 crops, where in terms of marginal revenue and marginal revenue will be 10, or marginal cost will be 2. So additional money flowing into this farm will be greater than additional money flowing out, or we can see this in our profit maximization process on the right, where cost is on the vertical and crops is on the horizontal. We have our horizontal marginal revenue structure, and we have our upward sloping marginal cost structure. At point B, we see that marginal revenue is greater than marginal cost, in that with additional money flowing in being greater than additional money flowing out, this farm has incentive to produce more crops. So they will consider point C. So considering point C, this farm is using 2 units of labor to produce 18 crops, where additional money flowing in will be $10, where additional money flowing out will be 2.5. We're looking at a graphical representation. We see that marginal revenue once again is greater than marginal cost, so this farm has incentive to produce more crops. Since they're profit maximizers, so they will consider point D, where at point D they will be using 3 units of labor in order to produce 22 crops, where money flowing in will be 10, whereas additional money flowing out will be 5. So once again, if we look at our representation, marginal revenue is above marginal cost. This firm has additional incentive to produce more, so they'll consider point E, where at point E, this farm is using 4 units of labor to produce 24 crops, where we see that marginal revenue is 10 and marginal cost is now 10. And in terms of representation, we see that the 2 curves intersect, and then additional money flowing in is now equal to additional money flowing out, in which this firm no longer has incentive to produce more or less of the good or service, and they'll cease at this point, in that if they were to produce more, they would be losing profits, where we would see this if they were to consider point F, where at point F, they would have 5 units of labor producing 25 crops, but now we see that marginal revenue is 10, while marginal cost is 20. So marginal cost is greater than marginal revenue, so additional money flowing out is greater than additional money flowing in, so this firm has incentive to reduce production going back to point E. So what we saw then was that the farm compares marginal revenue to marginal cost, where when marginal revenue is greater than marginal cost, the farm has incentive to grow more crops, whereas when marginal revenue is equal to marginal cost, the farm no longer has incentive to grow additional amounts of crops or less amounts of crops, whereas when marginal revenue is less than marginal cost, the firm has incentive to reduce its crop production, where overall our rule for profit maximization will be marginal revenue is equal to marginal cost, which leads to 4 units of labor producing 24 crops at a price point of 10.